Here's a question that sounds insane, but it's actually not. Is it possible for one company to own a dominant car company, a top bank, a toll road operator, and the pipes bringing water to your house, and be worth less than nothing? Not cheap, not undervalued, less than zero. Sounds impossible, right? Like bad math or trick question. Except that it's not a trick. It's happening right now on the Philippine stock market to a company called GT Capital. And by the end of this video, you're going to understand exactly how, more importantly, what it means if you're serious about investing. Now, let me just give you the number first, because it's the whole reason I'm talking to you about this in the first place. GT Capital, or GTCAP, owns a chunk of Metrobank, one of the biggest banks in the Philippines. And that one stake, just that one piece, is worth about 119 billion pesos. The entire company, or GT Capital, stock and all of it, is worth a smaller amount, about 102 billion pesos only. Let me say that again. One piece of the company is worth more than the whole company. That's a 17 billion peso gap on paper that shouldn't exist. Now, it's not quite as dramatic as everything else is worthless sounds. GTCAP owes about 63 billion pesos in debt. And once you properly account for that, the market isn't saying the rest is worth zero. It's saying that the rest, Toyota, the toll roads, Maynila, the water company, real estate, insurance, all of it combined is worth only about 46 billion pesos. Now, here's the interesting part. Toyota, just Toyota, made 19 billion pesos in profit last year. 1 year, one company. That's basically half of what the market is crediting for everything else GTCAP owns combined. That's not a rounding error. That's the market telling you something. The question is whether it's right. To understand how this happens, you have to go back to 1988. The Philippines had just come out of the first Marcos regime. Money was leaving the country, not coming in. Toyota wanted in, but they needed a local partner who wouldn't collapse the second things got difficult again. Now, the name that came up constantly wasn't a car dealer. It was a banker. George T., whose Metrobank had quietly survived the chaos of the 1970s and the 80s, while flashier banks didn't quite make it. Here's the smart part. Toyota didn't just hand over the brand and collect a fee, which is pretty much how a lot of these deals work here. The T's group, or Mr. T's group, kept majority ownership, and the Toyota's own people actually run the car business day to day. Very simple idea. Own the asset, let the expert operate it, and don't try to do everything yourself. Very smart. That decision paid off handsomely. And today, roughly 1 out of every 2 new cars in the Philippines sold is a Toyota. Not just leading the market. But here's a piece almost no one talks about. GTCAP also owns a slice of MPIC, or Metro Pacific, which means a piece of the toll roads you drive on, a piece of Meralco, or your power company, and a piece of Maynila, possibly where the water coming out of your tap is from. And right now, there's something big happening quietly in the background. MPIC's toll road business is in talks to merge with San Miguel's toll roads to build the largest expressway network in the country. Imagine, 2 of the most powerful businessmen in the Philippines are literally negotiating this publicly right now. If that deal closes, it forces an outside independent price tag onto a business that's only been valued privately. Now, this is a big deal, especially for a company whose stock price already seems confused about what it owns right now. Now, here's the real question though. Is GTCAP or GT Capital wrong to be this cheap, or does the market know something the rest of us don't? I use a system to answer that. Three steps. First, is the business quality good? Second, are the numbers or the financials healthy? And third, and this is the one that actually matters here, does management deserve your trust? Is the risk actually as safe as it looks? And is the price attractive enough to survive being wrong? On the first two, GTCAP mostly passes. Metrobank's a strong bank. Toyota dominates its market. Toll roads are about as safe a business as exists. Here's where it gets even more interesting. For management, the T family is genuinely looking at or genuinely good at picking the right partners and building real businesses. That's not in question. But they only pay out, here's the thing, they only pay out about 10% back to shareholders like you in dividends. Everything else is locked inside the company. The risk, here's something people get wrong. This isn't risky because it's not diversified. A bank, a car company, and toll roads is actually pretty diversified. The real risk is that all three of these businesses get hurt by the same one thing at the same one time, which is a weak Philippine economy. If people have less money, of course, they have few money to buy cars, and Toyota's parts get more expensive too as the peso weakens against the dollar, since a lot of what Toyota sells here is built with imported parts. Same economy, same weakness. Hits everything at once. That's the real danger, not the lack of diversity or correlation, the price. And here's where it matters most. Evaluation is good to be true. I add up all the pieces of GDCAP actually worth the bank, the car, the toll roads, real estate, everything using conservative, careful numbers, and I get a value of about 1,066 pesos per share right now. The stock trades at 473, which is a 56% discount. Even if I'm harsh or pessimistic with my numbers, stress testing against the worst case scenario, the discount is still a strong or a big 44%. So, what's the actual answer? Is it a real bargain or a trap? It's not a trap. A trap is when a company is cheap because it's secretly dying. That's not this at all. Metrobank is healthy. Toyota just had a record year. Debt is going down, not up. But it's also not a buy it and forget about it situation either. Nothing has actually forced this discount to close. Not a big dividend increase, not a signed deal yet on those toll roads. A cheap company can just stay cheap for years if the people running it are comfortable keeping the value locked in instead of distributing it. So here's what would actually fix this, I think, in my humble opinion. And it's not even complicated. One, pay out more of the profits, meaningfully more than just 10%. Two, actually finish that toll road merger and use it as proof that this can be done again with other businesses. Three, publish an actual, clear plan for how and when shareholders get paid, not just occasional surprise dividends. None of that requires a miracle. It just requires a family that spent decades being excellent at building value to get equally serious about distributing that value and sharing it. And that right there, for me, is the entire lesson. Not just about GD Capital, but about investing in general. Being right about what a company owns means absolutely nothing if you're wrong about whether you'll ever actually see that value in your pocket. So back to that opening question. How can a company be worth less than nothing? It actually can't. Not really. What you're actually looking at isn't a company that's worthless. It's a family that's brilliant at building value, and so far hasn't proven it knows how to meaningfully hand it back. That gap between building value and sharing it, distributing it, is the difference between a real opportunity and a trap that just looks like one. Stay integrated, stay ahead. I'll see you in the next one.